Financial ratios are analytical tools that help us interpret financial statements in a more meaningful way. They convert absolute numbers into relative measures, making it easier to understand the performance, compare companies, identify trends over time. For example, instead of simply knowing that a company has earned $100 million in profit, a ratio helps us understand how efficient that profit is relative to revenue, assets, or equity. Financial ratios play a crucial role in financial analysis and valuation. They help answer key questions such as: is the company profitable? Is it efficiently using its resources? Can it meet its short term obligations? Is it financially stable or leveraged? Ratios also form the foundation for financial modeling, credit analysis, and business valuation. Financial ratios are broadly classified into four major categories based on what aspect of the business they analyze. The first category is profitability ratios. These ratios measures the company's ability to generate profits. Key examples include gross profit margin, which measures the product level profitability, EBITDA margins, which measures the operating performance of the company, and net profit margin, measuring the overall profitability. For example, if a company has a high net profit margin, it indicates that it is efficient in controlling cost and generating profits from its revenues. The second category of ratios is efficiency ratio or asset turnover ratios. These are also known as activity ratios. These ratios evaluate how effectively a company uses its assets and resources. The examples include asset turnover ratio, which is how efficiently assets of a company generate revenue. Receivable turnover is how quickly cash is collected from the customers. For example, a high inventory turnover indicates that company is managing its inventory efficiently. The third category of ratios is leverage ratios. These are also known as solvency ratios. These ratios measure the company's financial risk and capital structure. Examples include debt to equity ratio and interest coverage ratio. A company with high debt may face higher financial risk, especially during economic downturns. The fourth category of ratios is liquidity ratios. Liquidity ratios measure the company's ability to meet its short term obligations. For example, current ratio and quick ratio. A higher liquidity ratio generally indicates that the company is financially stable in the short term. While financial ratios are powerful tools, they are not perfect and must be used carefully. Let us look at some important limitations. The ratios are based on historical data. Most financial ratios are derived from past financial statements. This means that they reflect past performance, not necessarily future potential. Difference in accounting policies. Companies may follow different accounting methods, for example, depreciation methods, inventory valuation methods. This can make comparison between companies less accurate. Ratios vary significantly across industries. For example, technology companies may have high margins and low assets. Manufacturing companies may have lower margins but higher asset base. So, comparing ratios across industries can be misleading. Ratio analysis also ignores qualitative factors. Ratios focus only on numbers. They do not capture important qualitative aspects such as management quality, brand strength, competitive advantage, etc. To summarize, financial ratios are powerful tools that help us simplify financial data, compare companies, evaluate performance, and support valuation decisions. However, they should always be used along with qualitative analysis with an understanding of industry context. When used correctly, financial ratios become an essential part of financial analysis, decision making, and business valuations. Thank you.